Hello friends, welcome to Premier UPSC IAS. So continuing with the economy lectures, today we are going to cover with government budgeting. Let's start. Government budgeting. Budget. An annual financial statement of income and expenditure is generally used for a government, but it could be of a firm, company, corporation, etc. The word has its origin in the British parliamentary exercise of preparing such statement way back in the mid 18th century from the French word budget, meaning a leather bag. Today, this word is used to mean the annual financial statement in almost all economies around the world. The Constitution of India has a provision under Article 112 for annual financial statement. Article 112 states that annual financial statement needs to be presented in the Parliament before the commencement of every new fiscal year, popular as the Union Budget. Development and non-developmental expenditure. All expenditure of a productive nature is developmental, like all investments on the heads of new factories, dams, bridges, highways, railways, etc. The expenditures which are of consumptive kind and do not involve any production are non-developmental, that is, paying salaries, pensions, interest payments, subsidies, defense expenses, etc. Plan and non-plan expenditure. Every expenditure incurred on the public exchequer is classified into two categories, the plan and the non-plan. All those expenditures which are made in the name of planning are the plan expenditure, and rest of all are non-plan expenditures. Basically, all asset creating and productive expenditures are planned. All consumptive, non-productive and non-asset building are non-planned and non-developmental expenditures. This classification used to adversely affect the whole budget process, formulation and implementation. Looking at this anomaly since fiscal year 2017-18 as announced in the Union Budget 2017-18, the government has shifted from the plan and non-plan classification of spending to revenue and capital classification. Revenue. Every form of money generation in the nature of income, earnings acts as revenue for a government or a firm. Such forms of money generation do not increase the financial liabilities of the government, that is tax incomes, non-tax incomes along with foreign grants. Non-revenue. Every form of money generation which is neither income nor earnings for a government or a firm is considered a non-revenue source. Receipts. Receipt means receiving or accrual of money to a government by revenue and non-revenue sources. Their sum is called total receipts. Receipts include all incomes and non-income accruals of a government. Revenue receipts. Revenue receipts of a government are of two kinds, tax revenue receipts and non-tax revenue receipts, consisting of the following income receipts in India. Tax revenue receipts. This includes all money earned by the government through the collection of different taxes, that is, all direct and indirect tax collections. Non-tax revenue receipts. This includes all money earned by the government from sources other than taxes. In India, they are profits and dividends, fees, penalties, and fines received by the government, etc. Revenue expenditure. It includes all the expenditures incurred by the government that are either of the current kind or revenue kind or compulsive kind. The basic nature of such expenditures are that they do not involve the creation of productive assets and they are of a consumptive kind. They are used either in a running productive process or government. Many such things fall under such expenditures in India. They are: 1. Interest payment made by the government on the internal and external loans. Salaries, pension and provident fund paid by the government to the government employees. 3. Subsidies forwarded to all sectors by the government. 4. Defense expenditures by the government. 5. Postal deficits of the government. 6. Law and order expenditures, that is of police and the paramilitary. A deficit occurs when expenses exceed revenues, imports exceed exports, or liabilities exceed the assets. Revenue deficit. It is the difference between the revenue receipts and the revenue expenditure. Effective revenue deficit. It is defined as the difference between the revenue deficit and creation of the capital assets. Fiscal deficits. It is the difference between what the government earns and its total expenditure, excluding non-debt creating capital expenditure. Fiscal deficit is equals to revenue receipts plus non-debt creating capital receipts minus total expenditure. Budget deficit. The difference between the total budgeted receipts and expenditure. Budget deficit is equals to budgetary receipt minus budgetary expenditure. Primary deficit. It is the difference between fiscal deficit and interest payments. Primary deficit is equals to fiscal deficit minus interest payments. Capital deficit. There is no such term in public finance or in economics as such, but in practice, one usually hears the use of the term capital crunch, scarcity of capital in day to day economic news items. Usually, the government faces the problem of managing as many funds, money, capital as is required by it for public expenditure. Such expenditure might be of capital kind or revenue kind. Such difficulties have always been with the developing economies due to their high level requirement of capital expenditures. Deficit financing. Financing of the gap between government receipts and expenditure. How does the government manage its deficits? 1. Monetized deficit. Borrowings made from RBI through printing fresh currency. The printed money is called high power money. FRBM Act disallows RBI to do this under normal conditions. 2. Ways and means advances. The Reserve Bank of India gives temporary loan facilities to the center as a banker to the government against the ad hoc treasury bill. There is no collateral, but the penal interest rate is charged. Revenue budget. The part of the budget which deals with the income and expenditure of revenue by the government. This represents the annual financial statement of the total revenue receipts and the total revenue expenditure. If the balance emerges to be positive, it is a revenue surplus budget, and if it comes out to be negative, it is a revenue deficit budget. Capital budget, the part of the budget which deals with receipts and expenditures of the capital by the government. This shows the means by which the capital is managed and the areas where capital is spent. Capital receipts. All non-revenue receipts of a government are known as capital receipts. Such receipts are for investment purposes and supposed to be spent on planned development by a government. But the receipts might need their diversion to meet other needs, to take care of the rising revenue expenditure of a government, as the case had been with India. The capital receipts in India include the following capital kind of accruals to the government. 1. Local loan recovery. 2. Borrowings by the government. And 3. Other receipts by the governments. Capital expenditure. All the areas which get capital from the government are part of the capital expenditure. It includes so many heads in India. 1. Loan disbursements by the government. 2. Loan repayments by the government of the borrowings made in the past. 3. Plan expenditure of the government. 4. Capital expenditures on defense by the government. 5. General services like the railways, postal department, water supply, education, rural extension, etc. Charged expenditure. It is the public expenditure which is beyond the voting power of the parliament and is directly withdrawn from the consolidated fund of India. For example, the emoluments of the President, Speaker, Deputy Speaker of the Lok Sabha, Chairman and Deputy Chairman of the Rajya Sabha, judges of the Supreme Court and the High Courts in India, etc. Various budgeting techniques. 1. Incremental budgeting. Incremental budgeting takes last year's actual figures and adds or subtracts a percentage to obtain the current year's budget. It is one of the most common method of budgeting as it is simple and easy to understand. Activity-based budget. Activity-based budgeting is a top-down budgeting approach that determines the number of inputs required to support the targets or outputs. Value proposition budgeting. Value proposition budgeting is really a mindset about making sure that everything that is included in the budget delivers value for the business or government. Zero based budgeting. Zero based budgeting starts with the assumption that all department budgets are zero and must be rebuilt from scratch. Zero based budgeting is very tight. aiming to avoid any and all expenditures that are not considered absolutely essential to the company's successful profitable operation. Types of budgets. Golden rule. The proposition that a government should borrow only to invest, that is, capital expenditure in India, and not to finance the current spending, that is, revenue expenditure in India, is known as the golden rule of public finance. This rule is undoubtedly prudent, but provided spending is honestly described as an investment and investments are efficient and does not crowd out the important private sector investments. Balanced budget. A budget is said to be a balanced budget when total public sector spending equals total government income revenue receipts during the same period from taxes and charges for public services. In other terms, a budget with a zero revenue deficit is a balanced budget. Such budget making is popularly known as balanced budgeting. Gender budgeting. A general budget by the government which allocates funds and responsibilities on the basis of gender is gender budgeting. It is done in an economy where socio-economic disparities are chronic and clearly visible on a sex basis, as in India. Gender budgeting started in India with the Union Budget 2006-7, which proposed an outlay of rupees 28,737 crore dedicated to the cause of women and created gender budgeting cells in 32 ministries and departments. Outcome and performance budgets. The concepts are part of result oriented budgeting. While the outcome budget is presented by different departments and divisions of a ministry or the government, the performance budget is presented by the Ministry of Finance on behalf of the government. Both go for quantitative as well as qualitative progress reports of the performance. The outcome budget is a micro level process, while the performance budget is a macro level process in budgeting. There are many outcome budgets in any one performance budget. The basic objective of such budgeting is to bring in transparency and thereby making the government more and more responsible to the House and the public. Naturally, they bring in prudence and optimization elements into public spending. Direct benefit transfer. In 2015, the new government in center introduced the game-changing potential of technology-enabled direct benefit transfers (DBT), namely JAM, Jan Dhan Aadhaar Mobile Number Trinity Solution. It offers possibilities for effectively targeting public resources to those who need them most and including all those who have been deprived in multiple ways. Under it, the beneficiaries will get the money directly into their bank or post office accounts linked to their 12-digit biometric identity number Aadhaar provided by the Unique Identification Authority of India UIDAI. The idea was first initiated by the Government of India 2013 UPA2 on pilot basis with 7 schemes in 20 districts of the country. Part of the technological platform from Digital India, it is expected to provide integration of various beneficiary databases with Aadhaar and appropriate process re-engineering. It will result in expenditure rationalization, removal of fake and duplicate entities from beneficiary lists, prevention of leakage and wastage, substantial saving of effort, time and cost, ensuring full traceability of flow of funds to the beneficiary, checking the element of corruption through transparency, accountability of flow of funds. Role of public investment. Several recent studies from India and abroad have been quoted by the Economic Survey 2014-15 to suggest an increase in the public investment in a targeted way. Role of public investment. Several recent studies from India and abroad have been quoted by the Economic Survey 2014-15 to suggest an increase in the public investment in a targeted way. Here, targeted public investment means government investment in a sector which can generate the largest spillover effects to the economy. In the present time, the railways has that level of spillover potential. The survey agrees with the famous observation of W. W. Rostow. The introduction of the railways has been historically the most powerful single initiator of takeoffs. The rationale for such a policy action has been emphasized by referring to the following documents and studies. The rationale for such a policy action has been emphasized by referring to the following documents and studies. It has been found that there has been a link between public and private investment in past which caused either rise or fall in the growth rate. The Central Statistics Office CSO data indicate that a boom in private corporate investment in the high growth phase of 2004 to 2008 was accompanied by an increase in public investment by about 1.5%. Similarly, a decline in public investment by more than 1 percentage point between 2008 to 13 is accompanied by a general decline in private corporate investment by more than 8 percentage points. The World Economic Outlook 2014, an IMF report, noted that increases in public infrastructure investment, if efficiently implemented, affect the economy in two ways. One, in the short run, it boosts aggregate demand and crowds in increases private investment due to the complementary nature of infrastructure services. In the long run, a supply side effect also kicks in as the infrastructure built feeds into the productive capacity of the economy. Infrastructure being the lifeline of an economy that bringing positive effects to all sectors. The studies of the IMF confirm that an increase in public investment can have a positive effects on output. The medium-term public investment multiplier for developing economies is estimated to be between zero point 0.5 and zero point 0.9. However, the magnitudes depend on the efficiency of implementation. In order to boost public investment, there are two challenges in this regard. Are mobilization of the financial resources to enhance public investment and implementation capacity. To the extent implementation capacity is concerned, a sector with the maximum positive spillovers, together with the proven capacity for investing quickly and efficiently, can serve the purpose. Two such sectors are rural roads and railways. Enhancing road connectivity can have a huge positive spillover on the economy. This has been shown by recent studies. The examples in this case are the National Highways Development Project and the PM Gram Sadak Yojana of early 2000s. These public investment moves encourage rural employment and earnings. The survey believes that the present government should encourage public investment in the hitherto neglected railway sectors, since it has the potential to have similar effects on the economy as the road sector could do in past. This has the potential to crowd in greater private investment and without jeopardizing India's public debt dynamics. Public investment has direct positive bearings on the growth prospects as per the empirical studies. India's productivity surge around 1980 was due to the boost in productivity led by the enhanced public investments in the infrastructure sector, in contrast to the demand creating effects. The study analyzes the effects on the overall growth using a framework where government infrastructure services are put. The study analyzes the effects on overall growth using a framework where government infrastructure services are input into private production. The results of the study indicate that allowing for the appropriate lag of around 5 years between public infrastructure spending and growth, the former can explain around 1.5 to 2.9% of the overall growth. A study by the RBI reports that the long-run multiplier of the capital outlays on GDP to be 2.4. The study also confirms that the effect of revenue expenditure on GDP, though high, fades out after the first year, suggesting gains from reprioritizing expenditures. Thus, the survey has emphasized a big role of enhancing public investment in the railway sector. It could be started as only public investment, but soon the impetus given by the government will generate enough avenues and new possibilities that the sector will start attracting enough investment flows from the private sector. Once such an effect is visible when there are several possible alternatives to promote investment, the PPP to be dedicated to private investments. Railways being a lead infrastructure sector, it will bring in multidimensional positive spillovers in the economy. Linking people and places has great potential in creating a great many numbers of openings in the economy. Tax structure in India. Tax. Tax is defined as a mode of income redistribution by the modern economics. The usual meaning of tax, people think that a tax is imposed by the government to fulfill its important obligations on the expenditure front. Incidence of tax. The point where the tax appears like being imposed is known as the incidence of tax, the event of tax imposition. Impact of tax. The point where a particular tax makes its effect or impact felt is known as the impact of tax, the after effect of tax imposition. Direct tax. The tax which has both the incidence and impacts at the same point is referred to as the direct tax. As for example, interest tax, income tax, etc. Indirect tax. The tax for which both incidence and impact are at the different points is referred to as the indirect tax. The person who is hit does not bleed, someone else bleeds. As for example, excise, sales tax, etc., which are imposed on either producers or the traders, but it is the general consumers who bear the burden of a tax. Methods of taxation. There are three methods of taxation prevalent in economies. One, progressive tax. It is based on the taxpayer's ability to pay. As income increases, taxes increases. High income earner will pay more tax than a low income earner. Example, Indian income tax. Regressive tax. A regressive tax is assessed as a percentage of the item being purchased. Everyone pays the same percentage regardless of earnings, so people with low incomes are hit much harder than those with large incomes. Example, sales tax. 3. Proportional tax. Proportional taxes are a flat tax system in which taxpayers pay a set percentage regardless of their income. Example, an income tax of 10% that does not change as income rises or falls is proportional tax. 4. Specific and ad valorem tax, another classification of taxes. A specific tax is a set amount of tax per unit sold based on the weight or number, etc. An ad valorem tax is a percentage tax based on the value added by the producer. As the value added increases, taxes also increase. Example, real estate. 5 principles of a good tax system. 1. Fairness, horizontal equity and vertical equity. 2. Efficiency, raise revenue with the least cost. 3. Administrative simplicity, reduce the work required to collect and pay taxes. 4. Flexibility, modify when needed. 5. Transparency, where the money is coming from, where it is going, should be open to all. Various direct taxes in India. 1. Income tax. It is charged directly on the income of a person. The rate charged is proportional to the level of income. Corporate tax. Levied on companies who exist as separate entities from their shareholders. Foreign companies are taxed on income that arises or is deemed to arise in India. Minimum alternative tax MAT, fringe benefit tax FBT, dividend distribution tax DDT, securities transaction tax STT are all levied on corporate. Examples of corporate tax. Wealth tax. Wealth tax is charged on the benefits derived from property ownerships. 4. Capital gains tax. Taxed on the income derived from the sale of assets or investments. Capital investments cover homes, farms, businesses, works of art, etc. The tax has been classified into two: one, short term, two, long term capital gain. Short-term capital gain (STCG). This type of tax is applicable if the particular asset has been sold within 36 months of owning it. In the case of short-term capital gain, the rate of tax is 15%, but the period becomes 12 months in case of shares, mutual funds, units of the UTI, and zero coupon bond. In this case, the rate of this tax is 15%. The criteria of 36 months have been reduced to 24 months for immovable property such as land, building and house property from financial year 2017 to 2018. Long-term capital gain (LTCG). His type of tax is applicable if the particular asset has been sold after 36 months of owning it. In the case of long-term capital gain tax, the rate of the tax is 20%. In case of shares, mutual funds, units of the UTI, and zero coupon bond, there is exemption, zero tax from this tax, provided that such transaction is subject to securities transaction tax. The reduced period of the aforementioned 24 months is not applicable to movable property such as jewelry, debt-oriented mutual funds, etc. They will be classified as a long-term capital asset if held for more than 36 months as earlier. Other direct taxes in India. Fringe benefit tax (FBT) is a tax payable by employers for benefits paid to an employee in place of a salary or wages. 2. Dividend distribution tax (DDT). Dividend distribution tax is imposed by the government of India on its companies according to the dividend paid to a company's investors or shareholders. 3. Minimum Alternative Tax (MAT) is payable under the Income Tax Act. The concept of MAT was introduced to target those companies that make huge profits and pay the dividend to their shareholders, but pay no or minimal tax under the normal provisions of the Income Tax Act. Securities Transaction Tax (STT) is a tax payable in India on the value of securities, excluding commodities and currency, transacted through a recognized stock exchange. Indirect taxes. Value added tax. The value added tax (VAT) is a method of tax collection as well as the name of a state level tax at present in India. A VAT is collected at every stage of the value addition, that is, either at the stage of production or distribution. Nomenclature itself indicates that this tax is collected on the value added, that is, production to the products. Production of goods or services is nothing but stages of value additions where the production of goods is done by the industrialist or manufacturers. But these goods require the value to be added by the different service providers or the producers like the agents, the wholesalers, and the retailers before they reach the consumers. There are many points where value is added in all goods, from production to the level of sale. Method of tax collection in VAT is different from the other non-VAT methods. VAT is imposed and collected at different points of value addition chain, that is multi-point tax collection. The non-VAT method, there is a single point tax collection. VAT does not have a cascading effect on the prices of goods. Therefore, it does not increase inflation. It is highly suitable for an economy like India, where, due to a high level of poverty, a large number of people lack the market level purchasing capacity. VAT is considered as a pro poor tax system without being anti rich because even rich people do not suffer because of it. Experience of VAT. A total number of 20 states or UTs which switched over to VAT from the existing sales tax in April 2005. Rest of the states went for it by 2008 or 9. Majority of the states or UTs saw revenue buoyancy due to VAT in the very first year of its implementation. Few states availed the central compensation facility for their revenue losses, that too for hardly 1 or 2 years. Experience of implementing VAT has been quite encouraging. By the financial year 2016 and 17, the tax revenues of the states and the UTs were estimated to grow with an annual rate of around 16%. This way, the view that the VAT will increase the tax collections of the states has been validated. GST is believed to have a similar impact on the indirect tax collections of the states as well as the center. GST, Goods and Services Tax, a big bang reform post 1991. Definition: it is a comprehensive tax levied on the manufacture, sale, and consumption of goods and services. Features of GST: the GST is a destination based consumption tax made on value added to the product. GST includes services tax also. Central value added tax, additional customs duty, special additional duty of customs, central sales tax, service tax, state VAT or sales tax are some of the taxes that have been merged to form the GST. The GST has a four-tier rate structure. The tax slabs are fixed at 28%, 18%, 12%, and 5%, besides the 0% tax rate on the essentials. GST is applied when turnover of the business exceeds rupees 20 lakhs per year. Limit is rupees 10 lakhs for the northeastern states. Input tax credit. Input credit means at the time of paying tax on output, tax paid on input would be deducted. There is an equal sharing of GST tax revenues between the center and the states 50-50 ratio, except the IGST. The GST Council has adopted a dual GST with two components, the central GST and a state GST. The IGST comes to play when the commodity is produced in one state and is traded to another state, interstate trade. In this case, the share of the SGST should go to the consuming state as the GST is a destination-based tax. Composition scheme is an easy, low procedure, and compliance friendly tax scheme for small and medium enterprises, goods, and services. Less number of tax returns filed or return on a quarterly basis. Turnover limit for availing this scheme is less than 1.5 crores. Availability only for intra-state supplies. No input scheme facilities available. E-commerce firms can't opt. Exports are exempted from GST as in the case of the previous regime. Advantages of GST: 1. Removal of cascading effect of taxes. 2. Free flow of input tax credits. 3. Common market throughout the country. 4. Boost overall business efficiency. 5. Level playing field in the international market. 6. Lowering of tax rate and widening of tax base. 7. Equal distribution of taxes between the manufacturing and service. 8. Spurt in the GDP growth rate of India. Goods and Services Tax Council, key decision-making body. Union Finance Minister is its chairman. Anti-profiteering screening committees will be set up by the council. National Anti-Profiteering Authority. It is an institutional mechanism under GST law to check the unfair profit-making activities by the trading committee. Its core function is to ensure that the tax reduction will be passed on to end consumer customer. Goods and Services Tax Network. It is non-for-profit organization jointly owned by government and private players. Commodities Transaction Tax. The Union Budget 2013-14 has basically reintroduced the Commodities Transaction Tax (CTT) only for non-agricultural commodity. Commodities Transaction Tax (CTT) is a tax similar to Securities Transaction Tax (SIT) proposed to levy in India on transactions done on the domestic commodity derivatives exchanges. Globally, commodity derivatives are also considered as financial contracts. Financial Transaction Tax. The concept of CTT was first introduced in the Union Budget of 2008-9. Tax planning, tax avoidance, and tax evasion. Tax avoidance basically means exploiting or making use of the loopholes in the tax law to one's own advantage to reduce the tax burden. Tax avoidance is not avoidable, though it is 100% legal. Tax evasion. Tax evasion means not paying one's taxes, therefore, it involves the breaking the law. Tax planning. It is the art of reducing tax liability by using the various provisions of law. The government provides various deductions and exemptions which can be used by a person to reduce his tax liability. Example, investment in mutual funds, savings, certificates, etc. Steps taken by the government to reduce the tax avoidance in India. Renegotiating double taxation avoidance agreement. DTAA, also referred to as tax treaty. DTAA is a bilateral economic agreement between two nations that aims to avoid or eliminate double taxation of the same income in two countries. India has the DTAA with 84 nations. Advanced Pricing Agreements APA. An advanced pricing agreement is a contract for multiple years between a taxpayer and at least one tax authority. APA involves specifying pricing method that the taxpayer will apply to its related company transactions. APA provides a sense of certainty to taxpayers, leading to reduction of tax disputes and avoid tax avoidance. General Anti-Avoidance Rules GAR. General anti-avoidance rules includes a broad set of rules which are based on general principles to check the potential avoidance of the tax in general. The government set up a panel under the Parthasarathi Shrom to review the proposals with regards to GAR. Base erosion and profit shifting BEPS. Base erosion and profit shifting refers to tax planning strategies that exploit the gaps and mismatches in tax rules to artificially shift profits to low or no tax locations where there is little or no economic activity. OECD and G20 countries, along with the developing countries that participated in the development of the BEPS package, are establishing a modern international tax framework under which profits are taxed where economic activity and value creation occur. Other steps taken by the government in recent times to prevent the tax avoidance and evasion are enactment of the black money, enactment of the Benami Transactions Prohibition Amendment Act 2016, quoting of PAN made mandatory for sale or purchase of any goods or services above rupees 2 lakhs, exchange of information under tax treaties. India joined a group of 48 countries as early adopters to new global standards for automatically exchanging information from 2017. Terminologies related to taxation: tax incidence, tax burden, tax expenditure, tax space, tax buoyancy, percentage change in tax revenue with the growth of national income, transfer pricing. It involves the setting of the price for goods and services sold between the controlled or related legal entities within an enterprise. Arm's length principle price is the price at which two unrelated parties will make a deal, hence market forces of the supply demand will work. Says tax or additional levy on tax, it is imposed for a specific purpose and can be used for designated ends only. Example, education says surcharge, tax elasticity,